Hello again, Professor Morgan-Nance here. In this set of videos, we will cover the last part of the asset side of the balance sheet before moving on to liabilities and equity. As we've discussed previously, please review these learning objectives as you progress through the chapter to ensure you're on track. You will also find them in your chapter checklist. We are now at the end of the asset section of the balance sheet, in the area where companies report plant assets and intangible assets. Before we get started, can you name the income statement account where we record the cost of using plant assets? If you name depreciation expense, you're right. In this chapter, we will discuss how to account for the acquisition, the use, and the disposal of long-lived assets. There are three major types of long-lived assets that we will discuss. Plant assets are tangible assets that are used actively in the operations of the company. We looked at some of these in Chapter 3 already. Natural resources are used up or physically consumed by the business as part of the business operations. Companies that have natural resources assets include Chevron, they have oil and gas reserves, and Sierra Pacific Industries, who has timber stands. Intangible assets are non-physical assets that confer certain rights and privileges to the owners that benefit the business. Examples of intangibles include patents, trademarks, and copyrights. Long-lived assets share certain attributes. They are actively used in the business and acquired for use over multiple years, and their cost is allocated to the income statement over the periods that benefit from their use. Let's consider the first category, plant assets. Plant assets are tangible assets that are used actively in the operations of the entity. Plant assets make up a large part of assets on most balance sheets and are depreciated as we use them. The exception to this rule is the asset land, which is not depreciated because it has an indefinite life. Here are some distinguishing features of plant assets. Number one, they are used in operations as opposed to being inventory. Inventory is held for sale and not used in operations. For example, a computer retailer may have computers that it sells to customers, but it also has computers that it uses to handle accounting and other operational functions. They are not held as investment for future sale or use like land sometimes is. And they also, number two, plant assets also have lives that extend beyond 1 year. Now, this slide graphically represents a plant asset's life cycle from acquisition to sale. You'll see that accounting for plant assets is similar to how we account for intangible assets and natural resources. Four main areas exist where we must make decisions about accounting for plant assets. First, how much cost should be recorded as an asset in the general ledger? Second, what are the acceptable methods to allocate the cost of most plant assets against revenue in the proper periods? Remember calculating depreciation expense in Chapter 3? Well, we'll learn more about it in this chapter. Depreciation is the matching principle in action. Third, how do we account for ongoing expenditures such as repairs and improvements? And fourth, how do we account for the disposal of the asset, including removing it from our books and calculating any gain or loss? Now, take a few minutes to review the journal entries that you learned in Chapter 2 to acquire plant assets and in Chapter 3 to record depreciation expense. You'll be using these again in this chapter. Plant assets are recorded at cost. We say cost is capitalized when acquired. This is consistent with the cost principle. As we'll see on the next few slides, cost includes all amounts required to get the asset in place and ready for its intended use. However, it does not include repairs completed after the asset is placed in service. Let's look at a few examples of what costs are capitalized, starting with machinery, then moving on to land improvements, and buildings. Machinery and equipment includes assets like forklifts, coffee roasters, assembly lines, packaging machines. The cost of machinery and equipment consists of all costs to purchase them and prepare them for their intended use, less any discounts received. For example, the company may have to pay delivery charges on the machine, and these costs are included in the amount recorded in the general ledger asset account. If we need to install any special parts to make the machinery or equipment ready for its intended use, we will include these costs in the recorded price of the asset too. Now, all costs to acquire land and land improvements and buildings after making them ready for their intended use are capitalized. This is true whether we purchase or construct the assets ourselves. Several types of capitalizable costs are shown on this slide. Such costs may include broker or legal fees, design fees, cost to demolish an old structure on the property, that goes into the cost of land, the cost of grading a property, building permits, etc. The cost of each of these types of assets is recorded in its own general ledger asset account. So let's consider each type in a little more detail. Land, first of all, is not depreciated. It is the Earth's surface, so it has an indefinite or unlimited life. When land is purchased for a building site, its cost includes the total amount paid for the land, including any real estate commissions, any title insurance fees, any legal fees, etc. Payments for surveying, clearing, grading, and draining are also included in the cost of land. And when land is purchased as a building site, if existing buildings must be torn down, the total cost charged to the land account includes the purchase price plus the cost of removing the structures, less any amounts recovered through the sale of salvaged materials. Unlike land, building and land improvements do have a limited life and therefore they are depreciated. Land improvements are things attached to the land. Think of all the things on the land around you as you go to school, work, or run errands. Examples are parking lot surfaces, driveways, walkways, fences, landscaping, and sprinkling and lighting systems. Because the cost of all of these improvements increase the usefulness of the land, they are charged to a separate land improvement account so that their costs can be allocated to the periods they benefit. It is fairly common to buy different types of assets with different depreciable lives for a lump sum price. This transaction is called, of all things, a lump sum purchase. Land and buildings are often purchased together, for example. Now, this can create a problem for us because land is not depreciable, but the building is. To properly account for depreciation on the building, we must assign portions of the purchase price separately to the building and to the land. When faced with this type of situation, accountants normally allocate or split the cost of the purchase among the assets acquired based on their relative market values, which is usually determined by appraisals that are completed during the purchase process. To illustrate, assume that Matrix paid $190,000 in cash for a group of items consisting of land appraised at $84,000 and a building appraised at $156,000, and cash closing costs were $10,000. In addition, Matrix had to upgrade the building after the purchase before using it and paid $50,000 in cash to do so. Now remember, our objective is to determine how to divide the total acquisition cost between the cost of the land and the building. How would you do this then? So pause the video for a moment and think about how you would accomplish the allocation of these costs. You would begin by calculating the relative appraised value for the land and the building as a percentage of total appraised value. The total appraised value is $240,000, and the land has an appraised value of $84,000. Therefore, the land is valued at 35% of the total of $240,000. We get the percentage by dividing $84,000 by the total fair or appraised value of $240,000, and we do a similar calculation for the building. Next, we multiply the percentages we just calculate times the total cost of the land and building, and that's the purchase price plus closing cost of $200,000 to determine the amount assigned to each asset. In the case of land, we multiply 35,000 times 200, or 35% times 200,000 and assigned $70,000 to the land account, and the remainder, or $130,000, is assigned to the building account using the same method. And don't forget, please, we need to add $50,000 to the value of the building for the renovation cost. $70,000 was allocated to the cost of the land and is recorded as a debit to the land account. $130,000 was allocated to the cost of the building and is recorded as a debit to the building account. And cash of $200,000 is credited and is equal to the sum of the cash paid for the land and the building plus the closing cost. Now, the cost of the renovation is recorded separately because it occurred later, after the initial purchase. The entire cost of $50,000 is recorded in the building account, and you'll see an example of a lump sum purchase in your homework. That's it for now. See you in a little bit when we come back to talk about depreciation.